What if the biggest mistake in your business journey happens when you think you are finally ready to leave? Many owners spend decades building companies worth millions, but a poor exit strategy can quietly destroy the value they created. The shocking truth is that buyers do not only look at revenue, they look for stability, systems, and future potential. One wrong decision before selling can reduce offers, delay deals, or even stop a transaction completely. Today, we uncover the 5 biggest mistakes business owners make before selling their companies. Let's start with number 1. Mistake 1. Waiting too long to prepare your business for sale. Many business owners believe that selling a company begins when they contact a buyer. That is one of the biggest misunderstandings in the entire process. A successful business sale does not happen overnight. It is a result of years of preparation, improvement, and strategic decisions. Imagine building a house for 30 years and deciding to repair it only 1 week before selling. You would not have enough time to fix structural problems, improve the appearance, or increase its value. Selling a business works the same way. A buyer is not simply purchasing your current income. They are purchasing the future possibility of that company. Before making an offer, buyers want to know whether the business is stable, organized, and capable of continuing without major problems. They examine questions like, can this company survive without the founder? Are customers loyal to the company or only to the owner? Are financial records accurate? Does the company have systems that support future growth? Many owners discover these questions too late. They enter the market expecting buyers to focus only on their success story. However, buyers focus on risk. A company that is prepared creates confidence. A company that is rushed creates doubt. And doubt is expensive. When buyers see uncertainty, they often reduce their offers because they calculate the cost of fixing those problems after purchase. This is why smart owners begin preparing long before they plan to sell. They improve operations. They strengthen leadership. They organize finances. They create systems that allow the company to operate smoothly. The goal is not to make the business look perfect. The goal is to make the business easy for another person to understand, trust, and continue growing. The best sellers do not wait for a buyer to discover the value of their company. They build that value before the selling process begins. Mistake 2. Making yourself the only person who can run the company. Many entrepreneurs build successful businesses through their own energy and determination. They make important decisions. They maintain relationships with customers. They solve problems when challenges appear. In the early stages of a company, this personal involvement is often the reason the business survives. But as the company grows, the same strength can become a weakness. A buyer wants to know one important thing. What happens to this business when the owner leaves? If the answer is, the company cannot function without me, then the value of the business immediately decreases. Why? Because buyers are not looking to purchase a job. They are looking to purchase an organization. A valuable company has systems, employees, and leadership that can continue operating after ownership changes. Think about large companies around the world. Their success does not depend on one person making every decision. They have teams, managers, procedures, and structures that keep everything moving. Small businesses need the same mindset. An owner should slowly move from being the person who does everything to the person who builds a team capable of doing everything. This means training employees, creating clear responsibilities, documenting important processes, and developing future leaders. A company becomes more attractive when customers trust the brand instead of only trusting the founder. It becomes stronger when employees understand their roles without constant supervision, and it becomes more valuable when a buyer can imagine stepping into ownership without fear. Many owners accidentally create a company that looks successful but depends completely on them. The business may generate strong profits, but buyers see hidden risk. Reducing owner dependency is not about removing yourself from the company. It is about creating something powerful enough to continue without you. That is the difference between owning a business and building a valuable asset. Mistake 3. Mixing personal and business finances. One of the easiest ways to reduce the value of a company is by creating confusion between personal money and business money. Many business owners make this mistake because, in the early years, they manage everything themselves. The same bank account pays business expenses, personal purchases, family costs, and other items. At first, this may seem harmless. The business is growing. The owner understands every transaction. There's no immediate problem. But when the time comes to sell, this habit can become a serious obstacle. A buyer does not only want to know how much money the company earns. They want to understand the true financial health of the business. They need clear answers. How much profit does a company actually generate? Which expenses are necessary for operations? Which costs belong only to the current owner? Are the financial numbers reliable? When personal and business expenses are mixed together, these questions become difficult to answer. A buyer may begin to wonder, if the financial records are unclear, what other problems might exist? This creates uncertainty, and uncertainty can lower the value of a company. Professional buyers make decisions based on evidence. They are not by emotions, history, or personal sacrifice. They are evaluating future opportunity and financial performance. A company with clean financial separation sends a powerful message. This business is professionally managed. It shows that the company can transition smoothly to a new owner. Strong financial discipline is not only useful for selling, it also improves daily decision-making. When owners clearly understand business expenses, profits, and cash flow, they can make better strategic choices. The simple lesson is this: treat your company like an independent asset, not like a personal wallet. The cleaner the financial picture, the more confidence buyers will have. And confidence is one of the biggest factors that determines business value. Mistake 4: having weak or unorganized business records. A business owner may believe that strong sales, loyal customers, and years of hard work are enough to attract a buyer. But during the selling process, one thing becomes extremely important: proof. Buyers need evidence that the business performs the way the owner claims. This evidence comes from organized records, financial statements, tax documents, customer information, contracts, employee records, operational reports, growth data. These records tell the story of the company. Without them, even a successful business can appear risky. Imagine buying a company and discovering that important information is missing. You do not know exactly how profits are calculated. You cannot clearly track customer relationships. You cannot verify important expenses. Would you feel comfortable paying a premium price? Probably not. The same happens when buyers evaluate companies. Poor documentation creates questions. Questions create delays. Delays create negotiation problems. And negotiation problems can reduce the final offer. Many owners underestimate how important preparation is because they know their business personally. They remember every customer conversation. They understand every process. They know why certain decisions were made. But buyers do not have that history. They only see what can be verified. A strong seller makes the business understandable to someone who has never been inside it. This means creating organized systems before entering the market. The goal is simple: remove surprises. A buyer should not discover important information after the deal begins. The best companies are not only profitable, they are transparent, organized, and easy to evaluate. That is what creates trust. And trust creates stronger opportunities during a sale. Mistake 5: selling without the right professional guidance. The final mistake many entrepreneurs make is trying to sell their company alone. Business owners understand their industry, customers, and operations, but selling a company requires a different skill set. Valuation, negotiation, legal decisions, buyer analysis, and deal structure all play a major role in achieving the best outcome. Many owners become emotionally attached to their business and focus on what they built, while buyers focus on risk, growth potential, and future returns. A professional advisor helps bridge this gap by understanding buyer expectations, positioning the company correctly, attracting serious offers, and negotiating stronger terms. The right advisor does not simply promise the highest price. They create a realistic strategy that protects value and improves the chances of a successful deal. Remember, selling a business is not only about finding a buyer, it is about creating the best possible outcome for your future. There you have it, the 5 biggest mistakes business owners make before selling their company. Building a valuable business requires preparation, smart decisions, and a clear exit strategy. Protect the legacy you created by planning early, building strong systems, and making your company ready for the future. If this video helped you, press the like button, share it with another entrepreneur, and hit the subscribe button for more business insights.